filter stocks based on certain criteria. For example, you could input a price to earnings or PE ratio lower than, say, 15 to find companies that might be relatively cheap compared to their earnings.
The PE ratio, that's a common one. But a low PE doesn't automatically mean it's a good buy, right?
Absolutely not. It's just a starting point. You need to understand why the PE is low. But beyond PE, what are some of the key financial indicators that serious value investors really scrutinize to determine if a stock is a hidden gem?
Yeah, what are they digging for in those reports?
Okay, one foundational concept is book value. This is basically an appraisal of all a company's assets. It's real estate, equipment, inventory, intellectual property like patents or brands, and it's cash. Think of Disney's book value. It includes its theme park land, its studios, its vast film library, even the value of Mickey Mouse himself.
Okay, so what the company physically and intangibly owns.
Right. Then there's a related concept, tangible book value. This focuses specifically on the physical assets in cash, deliberately excluding those intangible assets like brand reputation or patents, because those could be harder to put a concrete, reliable price on, especially in a liquidation scenario.
So tangible book value is more like the hard assets value.
Exactly, more conservative. Another crucial metric is enterprise value, or EV. This represents the theoretical takeover price, the total value of the company, including its market capitalization, stock price times shares outstanding, but also factoring in its debt and subtracting its cash. Believe it or not, a negative enterprise value can sometimes pop up, potentially signaling deep undervaluation, particularly in distressed situations.
Negative value, how does that work?
It usually means the company has more cash than its market cap plus its debt combined. It's rare, but it happens. Then there's franchise value. This is that intangible but very real worth of a company's name, its reputation, its customer loyalty. Think of Apple again. Its reputation for quality allows it to command premium prices and maintain fiercely loyal customers. That's a massive asset, even if it's not on the balance sheet in the same way a factory is.
And dividends, you mentioned those earlier. Many investors focus heavily on those steady payouts.
Indeed. Dividend yield is a key metric for many value investors. It's the annualized payout from a company's share price, showing how much income investors can expect relative to the stock price. Many dividend investors prioritize companies with a history of steady, preferably growing high dividends. Apple, for instance, while also a growth story, is considered a solid dividend stock.
Okay. And Benjamin Graham, the father of value investing, he had his own special metric, right?
Yeah, he did. A classic Graham tool is net current asset value per share, often abbreviated as NCAV or NSAPX. This is calculated simply by taking a company's current assets, things like cash, accounts receivable, inventory, and subtracting